This is a learning unit 8 that has actually it's actually both 2 units. It's learning unit 8, which is the cash and cash equivalents. That's a bank reconciliation. I'm just going to give you a brief overview of the theory, and then we're going to move on to the trade and other receivables. And then we'll move, we're going to move on to, yes, trade and other receivables. And then we'll touch base on the inventory, and then we're going to end of things with the PPE. Right, so this class is going to come to an end at 8 o'clock. All right, cash and cash equivalents, which is learning unit 8, that's actually your bank reconciliation statements, basically your bank account. Right, we're looking at why is it necessary to prepare the bank reconciliation. I always advise the students, whoever that is actually close to me, that it's important to check your bank account. You need to actually request the bank statement on a timely basis from the bank, should they not send you one. The reason being, there's an error that can occur from the bank. It's important to know how much are they charging you, so that you'll be able to maybe check if you want to check, because most of the people will only care about, okay, the salary came in, this is what I'm going to do, and this is what I'll be left with throughout the month. Maybe just before payday, you're out. You don't have enough funds. So you don't have enough funds in your bank account. So it's important to actually have your own bank statement just to check on how to charge you. Especially people that are banking with ABSA and FNB, make sure that you do check your bank statement. All right, why is it necessary? You just need to ensure correspondent that the books of the first entry for the business and the bank statement, they correspond. So the books of the first entry will refer to the cash receipts journal and cash payments journal. So you will see on the bank statement, usually it has the debit column on the left side, and then it has the credit column on the second, or your second column is actually the credit side, and then you've got the balance. So the balance, it will show you how much are you left with. But the CPJ normally, the debit normally reflect the CPJ, and the credit normally reflect the CRJ, right? So which is why it has been seen as an extension of the bank statement. So as I've mentioned, the credit figures in the bank statement form part of the CRJ, and the debit figures in the bank statement form part of the CPJ. Remember, when you do the bank reconciliation statement, usually they will give you a half complete of your CPJ along with your CRJ. So the reason behind that is because they just want you to check on your bank statement as to whether all the figures that appear on your bank statement are they actually recorded there, all right? Or the incomplete bank reconciliation statement, and then you're going to check on your bank statement as is there anything that is actually missing so that you can reconcile. That's the whole idea or the reasoning behind that. Favorable bank balance is shown in the debit side of the bank account, and unfavorable will be shown on the credit side of the bank account. Remember, the bank account is an asset. It does increase on your debit side and it decreases on the credit side. So nowadays, people have got what's called access to overdraft, where your bank account will always have a minus balance or a debit balance. All right, so meaning that when it's a minus, it will reflect on the bank account as the credit side. And then when it's actually a plus, it will reflect under your bank account as the debit figure. Right. So the favorable bank balance, look at the difference. We've got the favorable account balance, and then we've got the favorable bank balance. It's on the credit side of the bank statement, while then favorable, it's also on the debit side of the bank statement. Actually, it's what I've just explained right now. Please note the following. Items not appearing in the bank statement but not in the cash journals, they must be entered in the CRJ or CPJ, and then the items in the cash journals but not in the bank statement must be recorded in the bank reconciliation statement. So that's where the students are getting confused as to if this is missing to appear in a statement, or if this is actually not appearing in the CRJ, where do I put the amount in terms of the reconciliation? So the theory is there in your book. You can always refer if you're getting confused, but the best way of doing this thing is to do more practice in a lot of questions. So the third bulletin says that items which can affect either the bank statement or the cash journals, and the errors made by the errors made by the business of the bank, or the bank errors made by the bank must be corrected in the bank reconciliation statement, and the errors made by the business must be corrected in the CPJ. So those are the most major important lines when you're dealing with the cash and cash equivalents. So items in the previous bank reconciliation statement but not in the bank statement, it's possible that you can have them under the recon but not in the bank statement. So the check issued in the previous or previous period and still outstanding in the current period, if the checks are not older than 6 months, they must be entered in the bank reconciliation statement as an RD check. So RD check, it means that maybe there was an insufficient funds in the business bank account, so it has to be returned back to the drawer. Right. So looking at the check that is actually older than 6 months, it must be written back. It must be written back in the cash receipts journal. So it's actually called a stale check. Check that is actually 6 months older without being processed. Anything else, that means it's a stale check. And we need to bear in mind the deposit that are shown on the debit entries in the bank account in the general ledger, but also in the credit entry in the bank statements. Let me go further down. And as well as the payment entries in the bank account in the general ledger, but as debit in the bank statement. So that's actually an error. You will find out that some of the deposits or the credit, the payments, they go vice versa in terms of the debit or the credit. Instead of putting it maybe on the debit side, it has been put it on the credit side. So that error must be corrected. So that's actually in a nutshell when it comes to your bank reconciliation statement. So I know a lot of students, they don't really struggle when it comes to the issue of the bank reconciliation statements. So, but this is what I'm going to do now. When we meet on Saturday, I'm going to compile 2 questions that are different, obviously from your chart, that has the bank reconciliation statements. All right, Learning Unit 9, that's the trade receivables control account. That's your trade and other. Basically, those are your debtors. All right, this is how it works. The first thing that you must know is when you initiate a debtor, you must just identify or recognize that as your asset. So I know a lot of students are actually having troubles with, okay, I'm dealing with a transaction. What am I establishing? Or what does the transaction entail? So the truth of the matter is, if you're not up to speed with your basic accounting equation, you're going to have what's called a continuous problem. Because that's a layout, that's a very much foundation when it comes to the issue of the basic accounting. All right. So, but let's just to give you a hint, it gives us a directive or direction as to what type of accounts are you dealing with, how you identify the type of account when you're given a transaction. It also helps you to understand what type of accounts increase on the debit side and decreases on the credit side. And for you to know that, it's easy, but I find a lot of students struggling to identify the types of transactions involved or the type of accounts involved in the transaction. But here is how it goes. Your assets and your expenses, they increase on the debit side and they decrease on the credit side, right? So it is your responsibility to know the list of those types of an asset and the expenses. And then again, equity, liability, and incomes, they do increase on the credit side and they decrease on the debit side. It is then your responsibility again to know, because I can't list all it's like endless list of the equities, the incomes, along with your liabilities. All right. So, but if you know those kind of transactions, at least you're halfway, so that it will be easier for you to identify what kind of a transaction is at when I'm given this kind. What type of an account is it when I'm given this kind of a transaction? So now, since we're dealing with a trade receivables control account, it is a debtor account. And a debtor is an account that increases on the debit side and decreases on the credit side. All right. So it goes as follows. It says that the credit transactions are regarded as trade and other receivables, as the credit buyer owes the business some money for the future payments as per the agreement. All right. So those that they were in the accounting when we were doing the cash journals or the subsidiary books, they would know that when you're selling goods on credit, you are raising a debtor. It doesn't start here. The beginning part of it start from the sales journal, and then that's where you build your trade and other receivables control account. All right. So it has nothing to do with your CPJ or CRJ because there's no money involved in there. So only the cash transactions affect your CPJ and your CRJ. If goods are sold on credit, it's a trade and other receivables. That means that your starting point should be on the subsidiary journals after identifying the transaction. And the least the issues of the such documents will come up later. But when we deal with the trade and other receivables control account, we are actually closer to approach what's called the statement of financial position. That means that we're ready to prepare the financial statement, specifically under the balance sheet. Right. So the payment period is known as the credit terms. It is predetermined by the credit policy of an entity, and many firms create what's called an allowance for credit losses. All right. This is how it goes. When you go to a store, let's say you're going to a Woolworths. Usually when you say you want to apply for the food account or the clothing account or the store account, they're going to give you what's called the credit, the salesperson. They take your documentation through to the credit manager. That person will be able to assist your assessment in terms of, do you worth credit worthy? How much can we give you? And they're going to determine the term as to how long should it take us to actually approve you. You understand? And then from there, as soon as the account has been designed for you, is the issue of the buy and pay, buy and pay, buy and pay. All right. As soon as you're starting with the buy and pay, they're going to be the credit terms in accordance with the company credit policy. So it works out in this way. Sometimes when you pay an account, you may find out at the cashiers, they tell you, do you want it under 6 months or do you want it under 12 months? There's a reason why are they saying that. Because if you do it under 6 months, it means in 6 months period will be done paying whatever that you will be owing them. And then it's going to help them to establish the interest that they're going to charge you on. All right. So, but here's the thing. When people create an account with the store, not everybody is going to pay the account on time. And then that's where we realize, that's where we are actually going to establish what's called the credit losses, all right? Or they used to call it the doubtful debt, meaning that you said you're going to pay us on the 31st of each month, but you're actually paying us on the 7th. You understand? So meaning that you're not meeting what's called the credit policy in terms of the agreement with them, right? So you're going to start being classified under what's called the doubtful debt up until they say you're a bad debt. Maybe you pay in 3 months instead of paying on a monthly basis up to date. And then up until they say, you know what, we try to be at peace with you in terms of the payments and then you can keep up. We are going to write you off as a debtor. Okay, so that's where they're going to hand everything over to the legal department. The legal department are going to be responsible in terms of calling you, charging you for the admin calls and all of those, or the letters that are sending via the post and everything. Okay, so this is how the breakdown of your trade and other receivables entails, all right? So what happened is, the Woolworths store, for example, they probably have, let's say, millions of store card holders in terms of the credit. What they do is they're going to design each and every individual data, and then at the end of the month or at the end of the period, they're going to combine them all together to form an account called trade and other receivables. So should people pay on time, they're going to be deducting from their individual account holders. But I'm going to move on to the second part here, which is the settlement discount granted. So the settlement discount granted is often referred to encourage quick settlements or early payments from debtors. So usually you'd find out that when you buy goods on credit, they charge you what's called the finance or the interest on that one. So they would constantly send you the letter or the SMSs to say that your capital figure is about 20,000 rand. But then if you're paying 20,000 rand, by the end of September, you'll be saving, let's say 5,000 or 6,000, whatever the amount it is. All right. So basically what they give is they give out the capital figure without the interest. All right. Or sometimes they just say, if you pay by tomorrow, we're going to give you 5% discount on that. All right. So when the stores grant you a discount, their revenue is actually going to be affected in a way that if they grant you a discount, let's say maybe of 10% of 20,000 rand, so probably 2,000 rand is going to be cut towards their revenue. So that will be 20,000 rand minus the 2,000 rand of the discount. So the revenue amount, it will no longer be the same as 20,000 rand. Now because of the discount, it came down to 18,000 rand. Right, it is normally written off at the end of the financial period and deducted from the sales in the profit and loss and other comprehensive income. Sorry, I just abbreviated that there. The profit and loss and other comprehensive income is your income statement. So when you do your revenue part there, you're going to look at what's called the discount. So you will say sales minus the discount, or you just say sales minus discount minus if there's any defects in the goods that you've been sold out to your customers. You're going to minus the returns. All right. So if you were in the class before, you realize that we dealt with the sales returns before due to maybe the defects of the goods or the expired goods or changing whatever. There might be a reason as to why they're actually retaining the goods. So the third one, we've got an allowance for the settlements of discount granted. An entity with the settlement discount granted policy must, at the end of financial period, create what's called allowance for the settlement discount granted for the current year sales. But those whose settlements falls within the next financial period. Right? So entities usually they create what's called the allowance for the settlement discount. It's more like a visualized amount, but based on their number of debtors. Right. The allowance for the settlement discount granted will reduce the sales amount. Okay. So the interest charged here. This applies to the outstanding debt if the account is actually not paid within the credit terms, and it increases the outstanding balance of the individual debtor and the balance of the trade and other receivables control account. It is exactly as pure as it is. You fail to pay, we charge you interest. We call you, we charge you. We send you letters, we actually charge you. That's why most of the people, they just say, but my debtor was actually 5,000 Rand. Why am I owing you 5,500 Rand? But you're still entitled to get the breakdown of how did they arrive at that figure. So one person in the sales department or in the debtors department will explain and call, so will come and will call and explain it through to you. What credit losses? We used to call it the bad debts, as I've explained or touched based on it up there. So it says that it is not always the case where the debtor will be able to pay the account on time as per the credit policy. And those kinds of debts are called the credit losses and irrecoverable debts. That's when the company will just write you off as a bad debt or as a bad payer. All right, the next one, let's look at the bulletin where it says that writing off the credit losses is a bad debt. The company's management has decided based on the company credit policy, the amount will be written off as a credit losses. When the credit losses are written off, the debtor's personal account, the trade receivables control account are affected. And this is how it is actually affected. The credit loss will be debited to the credit loss account and credited to the specific debtor's personal account and their trade receivables control account. Right, to explain this further is, let's say you're putting the T accounts for the trade and other receivables control account, and then you've got this credit losses for Puti is actually not keeping up with his account. Because the trade receivable control account is an independent asset account and it increases on the debit side. When you reduce it with that amount of the credit losses, it means that you have to move it to the credit side. I think we've got a question in regards to that. The practical part will show it when we come to the end. Allowance for the credit losses, creation of an allowance for the credit losses for the entity that has the credit policy should be mandatory, and creation should be based on an estimated credit loss. We're not going to go exact as to how much of the credit loss, but we just assume or estimate as to by the end of the financial period, we are estimating at how much will be the credit losses. We're not going to be exact on that amount. And when the allowance is created, the only accounts which are affected are credit losses and the allowance for the credit losses as a contra asset account. So the trade receivables control account will not be affected until the actual credit loss has been verified to be written off. The allowance for the credit losses is deducted from the trade receivable control account, and it will be shown in the statement of financial position. That is your balance sheet, people. All right. At the end of the financial period, this is what happened. Obviously, we'll be building up as to what affect your trade and other receivables control account. When we close off at the end of the financial period, the carrying amount, the balance carried down that we have, it's gonna go under the balance sheet. So this is how you're going to record it under your balance sheet. It's a non-current assets as your first line item, that's your PPE. And then you're going to have the current asset as your line item number 2. And then you're going to have trade and other receivables control account, meaning that your balance carried down at the end of the financial period is going to be recorded there. Okay, let's have a look at the examples here. Number one, it is determined that the outstanding trade debtors of Putin Limited at 31st December 2022 amounted to 100,000 Rand. Number two says the financial manager determined that the allowance for the credit losses account should amount to 4,000 Rand at 31st of December 2022. Right, when we close our books, the trade and other receivables amounted to 100,000. When we estimate the allowance for the credit losses, it amounted to 4,000 Rand. And let's look on how this was recorded. So as per the theory up there, you debit your credit losses with an amount of 4,000 Rand. So your statement of profit and loss, remember credit loss, it's a statement of profit and loss disclosure account. And then you credit the allowance for the credit losses. So that's your contract allocation account with the same amount, right? So the reason why we are debiting the credit losses is because it's an expense, all right? So expenses increases on the debit side. All right, let's look at the major big account there, the trade and other receivables control account. It goes through to your statement of financial position, that's your balance sheet. So your opening balance would be 100,000 Rand under your statement of financial position. And then you're now going to credit the allowance for the credit losses itself. Okay. And then you further credit your losses for the profit. You create what's called the key account for the profit and losses based on the allowance for the credit losses, and then you're going to debit that. Right? So let's look at when you increase the allowance for the credit losses. The financial manager determined that the allowance for the credit losses should amount to 5,000 Rand at the 31st of December 2022. An existing of 4,000 Rand, it's up there. And the new one is 1,000 Rand. So the adjustment would be 5,000 Rand. Remember, that's an increase. Let's look at a few things that you're going to consider. Trade receivables is not affected altogether when the allowance has been adjusted until it is verified. You remember that I highlighted that verified with the red, just to ensure how important it is. So the same principle of the debit and the credit will be followed accordingly, and the new perform was called the adjustment general. All right, so you're going to record it exactly the same as what we did up there. All right, and then let's look at the allowance when you decrease the allowance for the credit losses. The financial manager determined that the allowance for the credit losses account should amount to 3,000 Rand at the 31st of December. Remember, initially we had 5,000 Rand as an increase of 4,000 Rand start. So these are the factors that you have to consider. Trade receivables is not affected altogether when the allowance has been adjusted until verified. Guys, be very vigilant. I want you to be very careful. If you come across this kind of questions, when you see one of the answers that are given being trade and other receivable, just pause that as a no. It's not affected as well, unless if they tell you that the credit losses has been verified to be written off. Then that's when you say, okay, let me just consider my trade and other receivables control account. Sorry about that. So the same principles of the debit and the credit will be followed accordingly, and then you're going to perform what's called your adjustment general. Writing off credit losses when the allowance for the credit losses exist. There are two methods to be followed when the above happens, or when the allowance for the credit losses exist. The first one, when the credit losses occur, credit losses can be written off against the allowance. And then you debit the allowance, and then you create the specific debtor's personal account and the trade receivables control account. All right. This is how it goes now. When you debit the allowance now, it goes the vice versa. And then when you create that specific debt account, it's actually a different story altogether. Why are you debiting the allowance now? Simply because that specific debt is no longer existing in our books. How do you reduce that specific debt? Remember, it's an expense. When you draw off that person completely out of the personal account, you have to go towards your credit side, right? So, and then it will follow against the same process when you do your trading receivables control account. When you write off, it's going to come to the credit side. Okay, one of the examples, just before the 31st of July 2022, Putin Limited was informed that Jerome Smith, at that time owed 1,500 was declared insolvent. At the 31st of December 2022, credit sales amounted to 60,000 Rand, and only 45,000 Rand was received from the debtor in payment accounts. The financial manager determined that the allowance for the credit losses should amount to 2,500 for the 31st of December. Okay, before I tackle this one, I just want to emphasize that you guys need to practice a lot on your trading other receivables. Make sure that you read the allowances part. There is no way you can get an assignment without this part. Believe it or not. Believe it or not, you will get something like this in your assignments. Right. So when you do your theoretical part, when you start, please let me know so that I can help you. If you can't do it on your own, if you cannot do it on your own, I am here to help you. Right. Let's agree on that one. I want you guys to actually go to the next accounting if you're going to manage the accounting, or focus on the other modules and get done with this. And I do not want you to just get done with this. I want you guys to get done with this with an understanding. Because I don't want you to be like me. I know if you don't understand your first part of accounting, if you're going to measure with accounting, believe me, you are going to encounter a lot of problems when you do your second year and third year. This is the basic foundation, people. Right, enough with my politics. So this is how you're going to record your journal entry. Debit the allowance for credit losses with an amount of 1,500 Rand. Remember, it has been verified this time around. Then you credit the specific data, Jerome Smith, it's a trade data that of as recoverable with the same amount. Right. Remember, if this was actually not verified, it was going to go the other way around, where you're going to credit your credit losses as well as your trade and other receivables, and then obviously your allowance will be on the debit side. So the trade receivables control account is going to be in this way. You debit the credit sales with an amount of 66,000 Rand. Remember, we sold goods on credit, so that means that our debtors are going up. That's why you see the sales on the debit side. Credit losses, it has been verified. We are going to minus 60,000 with 1,500 Rand. And then we now going to have the credit of the bank account with an amount of 45,000 Rands. Okay, that's what we have received out of 50,000 Rands. So the allowance for the credit losses, you debit your trade and other receivables with an amount of 1.5. Contra allocation account is the opening balance of 2,000 Rands. Okay, just want to verify something. I think I was supposed to say the 2,500 Rand. Apologies for that. But credit losses, oh no, it's 2,000 Rand is for, yeah, 2,500 Rand. And the profit and loss account, you're going to credit the 2,500 Rand. And then you're going to credit the specific debtors, Jerome Smith, with an amount of 1.5. Okay, let me bring you guys up to speed. Any questions? You must be fine, right? Okay.
Yeah.
Oh, that's good. Recovery of the credit losses that has been written off. This is where the accounting gets very interesting because it goes back and forth, goes back and forth, goes back and forth. All right. This is how when you recover the credit losses. I went to the store, I opened up an account, I failed to pay as an agreement term, as the policy agreement terms. All right, they write me off as a debtor. That's an expense, it's gone, it's no longer there. I later say, guys, I've got a job, I'm gonna pay you back, right? And they're going to look at the system and check how much do I owe them, including the interest and whatever that they charged me. Remember, it was initially recognized as an expense that reduces your trading other receivables control account. Now I'm paying back, right? As soon as I pay that back amount of money, the company or the store is going to recognize that as an income because they are receiving the money back, all right? So that's why it says that when the money has been recovered, as it was previously written off, it must be recorded and disclosed separately. But when you do the income statement, remember your first line item is revenue, and then you put in your cost of sales, and then the difference would give you the gross profit or the gross loss, all right? And then you're going to create a line items called other incomes. That would include your dividends, that would include your rental income, that would include your credit loss recovery. Okay, so immediately when they say the written off Pooty is now paying back the company the money, it means that we're recovering the money back. That should be recognized as an income. That's when you're going to open that line item and say bad debt recovered or credit losses recovered. Right? Bulletin 2 says the recovered amount shall be debited against the bank account. Why is that? Because the money is coming through the business bank account, and the bank is actually an asset, which it increases on the debit side and credit the recovery account. Okay. It will also be disclosed in the profit and loss, and the previous credit loss account must be cancelled. Okay, so for you to cancel the previous credit, you are reconciling the amount. All right. So that's when I say the profit and loss account, that's the income statement, and that's where you create that line item called create what do you call it? Bad debt recovered. Okay, if you don't understand it, please pause me. I can re-explain it again. I don't have a problem with that. But now let's invite SARS, VAT, credit losses and credit losses recovered. If you are a VAT vendor, meaning that if you are registered for VAT, this is how it goes. Initially, when you start, when you sell goods on credit, it will include the VAT. Okay? So remember that's an output there because of the sale of the goods. Right. So you receive the capital amount with the VAT. You take the VAT towards SARS. That's where it belongs. Right? Then you're done with your transactions. So as I was a credit loss that has been recovered, you now receive the money from me, but because you've paid the money already to SARS, you go back and say, okay, I've recovered my client. Can I get my money back from you? Because I actually have paid you and I haven't regained that money back, and SARS will be able to actually pay you that amount of money. It says that the VAT amount collected if the business was registered as a VAT vendor is paid frequently as agreed to SARS. To my knowledge, when we do tax, I think it's on a monthly basis, or less if you have registered that on an invoice basis, meaning that as and when you receive the invoice, you pay over SARS. If the debt is not paid or written off, the vendor is allowed to claim it back. That's what I've just explained now from SARS. And as soon as that line is actually recovered, the vendor is paid the money. All right. So sorry, I think I've explained it wrong. Remember, when you paid the money and then you write off the client, you've got the right to go to SARS and say, pay my money back. But as soon as that line pay you back, you need to repay SARS back their money because you have recovered your money. All right. Let's have a closer look at the big account here. Trade receivables control account, that's your debt account. As many entities are selling their goods and services on credit, the consolidated debtors list shall be added as one and be debited against the trade receivables control account and credited under the sales account. That's what we call the double entry system. So I think we'll just, what do I want to say? That's basically what you call the double entry system. However, I think topic E is going to deal with what's called the incomplete record. Incomplete record simply means that when you analyze or view the transaction and you only see the effect of one transaction, just know that you are wrong. You should have a view of what could be a possible control allocation account, what would be my second leg, or what would be my third leg. That's how the standard in accounting entails. All right. So, but I just gave you an example there that you're going to recognize your trade receivables control account, and you're going to also recognize what's called the sales account. And that's how it actually works. I've got a question. All right. Here's the tricky part. First thing first, when you're given a question, any question in accounting, remember they're going to give you some of the transactions for no reason. For no apparent reason, they're just going to show them there. It is up to you as to whether you understand what is required or you do not understand what it is. All they want to test you is, do you well understand what I am giving you? Because if you don't understand, it means that all the transactions that are given in here, you're going to include in whatever the part is. But if you do there will never go wrong. There won't be any assumption. There won't be any estimates. You'll be like, okay, I know you go there. Okay, let me take you through it. All right. The question is relating to trade receivables control account, and the following transaction relates to the account transactions of Putty Limited for the December 2022. So the opening balance on the trade and other receivables control account is 65,000 rand. Right. In bracket, I said trade debtors control account. Why am I saying that? Is because when you do the T account for the trade debtors, you're going to say my opening balance brought down, and then you're going to say 65,000 rand with the debit side. All right, so I'll show you the T account when we actually towards the end of this question. So number 2 says the settlement discount granted is 350. It's a trade debtor account, and we've got as credit sales, so 45,000 rand. That's your sales. Remember, when credit sales is when you're selling goods on credit. So it's a sales account, debtors account, and then we've got the purchases returns of 1,230. It's a trade payables control account. It does not affect your trade receivables control account at all. Right, the sales returns, yes, it does. 1.2, it does affect your trade debtors account. That's why you see the trade debtors control account in the bracket. So they refer to drawer, it's a returned check bank, 200 trade debtors, right? Remember, when your debtor is actually paying you with an insufficient fund, it means that you're still in existing debtor because I haven't received your money. The check is empty as it may appear. Credit purchases, 5532, trade payables control account. It's a no. It doesn't fall under your trade and other receivables control account. Cash purchases, it's a no. Cash purchases, it's a cash payment journal. It affects your bank account on the credit side. And then we've got a settlement discount received with an amount of 250. That's a trade payables control account. Guys, you need to differentiate between the settlement discount received and the settlement discount payables for granted. Okay, especially or particularly when we're dealing with the trade payables control account or when we're dealing with the trade receivables control account. Right, so we've got the bank total trade payables control account. There's a bank account and the bank total receivables control account. And let's look at the recording here for the additional information. My apologies. Purchases journal was undercasted with an amount of 319. Increased the purchases journal while the sales journal was overcasted with an amount of 400,000 rand. That decreases the data. What? Purchases journal is when you're purchasing goods on credit. It doesn't affect your trade and other receivables journal. But the sales journal, because it was overcasted, it has to go through to the credit side of your trade and other receivables. There's an effect towards your trade and other receivables control account. Right, meaning that when you open up your T account, you're going to have the balance brought down as I've mentioned with the opening balance up there. And then on your credit side, you're just going to say sales journal or overcast with an amount of 400 rand on the credit side because it was over. The key word here is sales journal and overcast. Okay, the total of the trade receivables balance because the list of the trade receivable amounted to 1715, specific list of debtors. This does not affect your trade and other receivables control. However, it does affect a record of the specific debtors. What? An amount of 113 which has been written off as a credit losses, and it has erroneously been added to the credit sales amount with 45,000 rand in the trade receivables ledger account. Trade debtors, it does affect that. But credit losses with an amount of 120 has been posted correctly to the sales account and the trade receivables control account in the sales in the general ledger. Okay. So, but it was not posted to the specific debtors account in the trade receivables ledger accounts. Our trade, based on this transaction, our trade and other receivables control account is fine, perfectly fine. The only problem is the record for that specific data. It's not posted correctly. Credit note number 666 for 35 was recorded correctly in the sales returns journal, but posted to the incorrectly to the debit side of the personal account of the debtors and the trade receivables. For that, it does affect the specific ledger account. Okay, but one of the things that you must just know, they'll try and trigger you by bringing what's called the source documents. If you don't know if the source document falls under which specific subsidiary journal, you're going to have a problem because you will never know if it's a debit note or check counter foil or whatever the source document it may be, and then you're going to put it under the wrong required part. All right. So if you remember quite correctly when we're doing the subsidiary journals, I've mentioned the possible list of your sales documents in there. Please go and review them if you've got my notes. They are there. Otherwise, you can just go specifically to your study guide. You will definitely find them in there. An account with an amount of 15065 on pre-sales was received from PP Solutions. The cost of the freight must now be accounted for in the account records of Pooty Limited. I'm not sure about this one, but I think it does go under an account statement. This person is still a data received from, actually we are data to PP Solution. They sent us the statement to say that we still owe them an amount of 15065. But check number 200 Rand was the check for a data in payment of his account. The check was returned due to insufficient fund. You still owe us, right? So there was no money in your check. So it has been returned back to the drawer. Opening balance of the trade and other payables control account at the beginning was 25350. That's your trade and other payables control account. So you are required to prepare the correct and properly balance your trade receivables and trade payables control accounts for Pooty Limited. Reconcile the total list of the trade receivables balance. Okay. So in the meantime, we can do the trade and other receivables control account, but we can ignore the payables control accounts. Balance brought down 65,000 rands. Let's have a look at where is that. Right, if you look at transaction number one, we see the opening balance of the trade and other receivables control account is 65,000 rand. Can you see that? That's your opening balance. The reason why you see that on your debit side is because, like I said before, trade and other receivable control account is an asset and it increases on the debit side and decreases on the credit side. Discount received with an amount of 350 rands. Let's have a look at the discount received. What are they saying about it? The settlement discount granted with an amount of 350 rands. Remember, that's actually going to decrease your sales. That's why you see it on the debit side of your T accounts. But remember, guys, if you need this, I can actually send you it anytime. Right. Sales return. Let's get to the principal spread and forget about the amounts now. 1.2. But the remember, the balance brought down here, it forms part of your sales. And then when the goods are actually returned, for some reasons, they're going to decrease your sales. That's why you see the sales returns on the credit side, because they form part of the decrease under your sales returns journal. Dishonor check, I think it's supposed to be on the credit side. Sorry, dishonor check is supposed to be on the debit side. And the reason for that is because used in the data. So the data are actually increasing on the debit side. Credit losses, if you were written off, they decrease their trade and other receivables account. That's why you see them on the credit side with an amount of 113. So my apologies for that one with an account statement, but I think I was right by saying that we still owe them an amount of 15065. And the balance carried down this. When you do the statement of, let me just highlight it in a different color. This will just go to your statement of financial position. At the end of the current year, at the end of the current financial period. So it doesn't matter how much you get in there, but you just have to transfer that amount of money in there. That's why I put that as an X amount. As current assets, and we'd say trade other receivables. But and then you balance it off. But this is the most important part when you are doing the trade and other receivables control account. You're going to transfer that under your the statement of financial position under your current asset, and then you just say trade and other receivables control account. So reconciliation. These are the list of the reconciled items or balances that doesn't go through your trade and other receivables balance. So we've got the opening balance 1715. Let's see. Sorry, Let's see what are they saying about this. 1715. Right. Total of the trade receivable balance as per the list. This is the key issue. As per the list. As per the list of the trade and receivables amount and the specific list of debtors. This is the key issue that tells you that it's a recon account. So that has been installed here under your recon. So you got a credit sales of 120. I just want to go back and check this 70 box, right? Let me explain the 120 for you. Credit sales with an amount of 120 was posted correctly to the sales account, meaning that trade and other receivables control account, because of the sales account has been it has been posted correctly in here. No effect. On the trade debtors. Okay. Let me just quickly highlight that in green. Okay, no effect. Right, on this one, so that's why you see it under the recon part. Right, let's have a look at what the credit note says. Credit note number 666-435 was recorded correctly in the sales returns journal, but posted to the incorrect side of the personal account of the debtor in the trade receivables ledger accounts. But before I explain this, I just want to tell you, remember when you see the source document says credit note, you must just know that it's a source document for the sales returns journal. Right. So 35 rand, I just want to explain that here. So with the 35 rand, there was an error. So in terms of the standard, it says that if there's an error that has occurred before, you need to adjust the error by moving that figure to the correct required part. But how do you do that? You actually show that the error has moved from there to that one, and then you multiply it by 2. It is there written in the theory under. If you go under theory, guys, you will see this thing. You just have to read it, and then you will get that. So a balance at the end of the period in terms of the reconciling is up by 50 rands, 17,200 rands. Let me bring you up to speed. Right, inventory, the intro goes as follows. The goods kept being sold in the normal course of the business. So the inventory is one of those things that they come and go. It's not unlike your property, plant, and equipment assets. So inventory you buy from the suppliers, and then you sell them. And then you do what's called the inventory count at the end of the financial period. Okay. So they're also goods being used to manufacture for resale. So companies like, or the suppliers, let's say Mercedes-Benz, for example. So let me tell you this funny story. I remember when I was doing my, I think it was accounting for 3rd year, because it's more deeper. They going to ask you things like, when do you recognize certain type of asset? How is the measurement like? So I remember, I think it was in an exam where they confused me by saying they brought the Mercedes-Benz. It was a car manufacturing company. And they said something about cars that are actually on the floor plan. And that's why I got to be confused, because I didn't understand that the company that produces the car that can be used to produce an income for the business could be regarded as an inventory. My apologies. I think I was doing CTA on us. Yeah, I don't think it was 30. So they needed to test my understanding in regards to the inventory. So I think I failed to understand that the car that they produce for resale, they are actually regarded as inventory, as opposed to it being regarded as the PPE asset. You understand? Because I remember getting my script and they were describing that the car that you see on the dealer floor plan, they are not used for the production of goods and services for the company. They are manufactured for resale. And then that's when the deeper understanding of an inventory came into the picture. So I think since that time, every time when I get this accounting question, before I approach the required part, I make sure that I read to understand first. All right. So it's also the goods that are being used to manufacture for sale and goods consumed in the normal business of an activity. So those are goods that you buy, eat bread, milk, and all of those that you find them at Pick and Pay or ShopRite. Right. So you need to know that the control of inventory is performed by inventory count, and it is normally done at year end. Right. The reason why people are doing or companies are doing what's called the inventory count is because if your year end starts from the 1st of January up until the 31st of December, you need to know that not all of the goods that you see on the shelf will be sold when you close up the book under 12-month period. Right? Which is why you need to do what's called the inventory count at year end. So you just need to know as to how much of the inventory is left and how much does it worth. So that is going to be the opening inventory for next year when you calculate your cost of sales. And that's how it works. Let's look at the importance for correcting the inventory count. Valuation of inventory count must be correct, otherwise the entries set out in the financial statement will be incorrectly calculated and it will result incorrectly in the future events as well. So this is what happens. Suppliers are bringing the inventories into the store. You capture that, all of it. So whether there are damages, whether the clients are actually breaking down the mayonnaise or the tomato sauce on the floor, that is going to be regarded as a damage. And then if you've got an insurance, obviously that's going to be replaced on that one. But obviously there should be a recording system where you're going to record waste or damaged goods. Right, the valuation of inventory at historical cost. When determining of an inventory at historical cost, it involves other costs of purchasing that are historical cost valuation, and we do include the cost of transporting the goods. Those goods, they don't transport themselves. It's going to be a cost charged on the transportation of the goods. Importation duty, usually when you're importing goods, whether they come by shipment or they come with a flight or however the means, one railage on goods and purchases, inwards and outwards, and the insurance on the goods purchased. All right, so that usually form part of your inventory cost. So the disadvantage of using the historical valuation cost, if the inventory falls below the historical cost, the value stated is not realistic. Therefore, an inventory must be valued at the net realizable value. At this point in time, I think it's a very good alternative for the historical cost. So we need to stick up to our historical cost. But when you go future with your accounting, you need to expect that you're going to deal with the issue of the net realizable value. So the NRV is the price at which the inventory can be sold at. All right. Remember, entities or stores, they normally do what's called the markdown, or they do what's called the markup. So the markup is when you're running things at a profit, and the markup is when you want to get rid of the stock on the shelf. You'll be like, okay, let's go break even. We don't care, or let's go at a loss because we made the profit already out of this product. So because of you want to take it out of the shelf, maybe due to change of season, or maybe due to the change of fashion, then you can just sell them at. That's why you'd always say on the TV or on YouTube, we see this advert. Go to Woolworths, 65% of what. Don't be fooled by that. They know the reason why as to why they're marketing it in that way. Automatically, it might be the issue of they've made a profit already on that one, in most cases. Or nobody's interested in them anyway because of change in fashion is actually occurring. Right. Let's look at the methods of estimating the inventory valuation, gross profit method. And this method can be used if the inventory has been damaged or destroyed. So the example will be the sales amount, the cost of sales, and then you're going to use the gross profit. So you determine the gross profit percentage. You take the gross profit, you divide that by the cost of sales. Jimmy, I think you remember that. And Jessica, were you in the class the other time when we were doing the gross profit percentage? And this is how you do it. You just take your gross profit and then you divide that by the cost of sales, or you can also divide that by your sales amount. Let's look at the consistency in the application procedure. The valuation of inventory should be consistent throughout the year. However, should the change during the year take place, it must be disclosed. Disclosure can take place by means of a note in the financial statements. All right, good. You are valuing your inventory, let's say, with the FIFO, first in, first out method. So somewhere along the line, you decided to change and do it under the weighted average method. When you do what's called the note under the property, plant and equipment, you need to disclose that why there's a change. Okay, you need to disclose that first, there is a change, and then you're going to know that we have changed from this method to this method, right? And the reason why obviously is going to be with the management of the firm, but the disclosure should be there so that when the auditors come, you not get into a fight with them because they don't know the reason as to why you're changing that. And you can just change without noting it under the notes. Right, same applies to the depreciation method. When you change, you need to let us know. Disclosure of inventory in the financial statements. Inventory such as the packaging material, stationery, cleaning material are recognized as a current assets in the statement of financial position. All right, those that they were in my class, guys, I did not include what's called the inventory system methods. So the inventory system method includes the perpetual and the periodic inventory system. And why I did not include this in here is because remember we dealt with that before. I think when we were doing Learning Unit 5, if I'm not mistaken, we dealt with the inventory system. That is the periodic inventory system, and that's actually the perpetual inventory system. How it differs is that I think periodic inventory system, you open what's called the purchases account, and then under the perpetual inventory system, you open what's called the inventory account. Listen, and you need to take that into account. You might get a question where you get to be confused about, they'll say so and so has been selling the inventory, whatever, in regards to the inventory, and they've been using the perpetual inventory system. They're going to give you 4 different types of answers. The other one would include the inventory. The other one would include the purchases. They just want to test you as to whether you understand when you comply with certain method. Can you use inventory or can you use the purchases? Be careful when it comes to that. Right, it's 11 minutes after 7 o'clock. Can we be back at 16 past? I'm just going to give you 5 minutes break to drink water or have a snack, and then we'll be able to carry forward with the last unit, which is property, plant, and equipment. Okay, let's carry on with our last learning unit here. It's a property. PPE stands for property, plant, and equipment. So that's that basically falls under your statement of financial position. That's a balance sheet. What we're going to start things off with non-current asset. So the non-current asset are obtained with an intention to carry on a trade. I think I was supposed to say with an intention. The production of income, yeah, that's actually a trade, I'm correct. Well, they have an operating lifespan of more than a year, and they can be utilized over and over up until it does no longer function in property for the company. It's no longer functioning property for the firm. Right. So it can comprise of your tangible, intangible, as well as your financial assets. Right. Let's look at the examples of the PP under the tangible assets, and it goes as follows. We've got your building, we've got your machinery, we've got your vehicle, and then we've got your assets. And they can be charged and seen. Right, they must be shown under the statement of financial position under the heading called property, plant, and equipment. Please forgive me there because I just wrote PPE. Right, they can also be written off over the useful life, which provide for what's called the depreciation. That's the reason why we have these. Let me just highlight that. That's a key word when you're dealing with the statement of financial position of the property, plant, and equipment. At this stage, or at this point in time, when you're given the building, just know that it does not depreciate. When they give you the land and building, just know that it doesn't have the depreciation. The only effect it may have is they can add another building maybe in the year as part of the asset. All right, so the only asset at this point, I think you will see the depreciation of it because they're going to separate it when you're doing second year accounting. They're going to separate the land and the building. So the land will continuously not depreciate, but the building won't. You will see that on the second year. But when they can no longer be useful for the entity's operation economically, they must be replaced, and the process on the realization, which is the sale, are normally used to partly finance the new assets. Right? So usually, because they need to keep up with production, they have to scrap it or sell it, and obviously the process they get in there, whether it's a loss or it's a profit, they're going to utilize it to buy another machinery or another asset. So let's determine the property, plant, and equipment, which it includes all the expenses in getting any asset to the premises. It also includes the installation costs and the expenditure incurred in getting your asset to operate. All right, for example, let's say it's a computer. So the delivery is going to be part of the cost, and the installation by the IT department is going to be an additional cost as well. And then the cost incurred for that asset to actually operate, it will be part of your cost. What is not part of your cost? It's a finance cost on loan that has been obtained for the asset that are actually not included in the cost price of an asset. So finance cost is a no-no, right? Do not confuse the two, because when you do that, those that are doing tax 1541, the finance cost is, I think it does form part of your asset. Right. The next topic is safeguarding and control of the PPE. We're going to look at the location. So people that are actually working with PCs, when you are at that office, just know that the location has been noted. The serial number, it's a number that you see on your monitor as well as your desk, the box or the laptop. Cost price, they do have it. How much has it costed? And they're going to look at the date of the acquisition. When was it acquired? And they're going to estimate what's called expected lifespan. For how long is it going to be used? And obviously they might use it on carrying on a trade, right? So they need to determine the carrying amount as and when the depreciation occurs on a yearly basis. So we're going to determine what's called the current year depreciation along with the accumulated depreciation. So those are the things that the company safeguard and control the property plant and equipment of the firm. Sorry. Recording the property plant and equipment. Property plant and equipment are recorded at cost at year-end period. The asset account is balanced and reconciled within the asset register. So when they say the reconcile, they need to determine how much is the carrying amount there. Simply because it was revalued or it has a depreciation along with its own contra allocation account, which is called the accumulated depreciation. But let's look at the concept itself of the depreciation. The cost of owning an asset can be written off against the income over its useful life. Whether you like it or not, it does lose its own value. Tax, we call it the wear and tear. Depreciation is a systematic allocation of the depreciable amount of an asset over its useful life in accordance with the applicable methods. We've got methods of determining what the depreciation is, but we'll get that when we cross the bridge down there. Look on how you record the depreciation. Please do not, I think I've highlighted this in yellow by mistake. Sorry about that. Depreciation amount for the period must be debited as per the double entry system and the contra allocation account. Sorry, the contra allocation asset account called the accumulated depreciation must be credited. So basically, in terms of the double entry system, by actually showing the effect of two accounts or more, you're going to have the depreciation. Automatically the contra allocation account will be accumulated depreciation, despite otherwise. The difference between the cost, that's when you're doing the note, be careful here. The difference between the cost, depreciation, and accumulated depreciation amount is the net carrying amount that must be recorded in the statement of financial position. So this is how you're going to do it. You're going to say statement of financial position, that's your balance sheet, and then you'd say non-current asset. So the carrying amount that you have at the end of the financial period, that is your property, plant, and equipment. It means it's how much it's worth when we close the books at the end of the financial period. Look at the method in calculating the depreciation. We've got the cost, which is also called the straight line method. That's a cost minus the residual value multiplied by the rate or divided by the number of years. Right, so in most cases, you don't get what's called the residual value, but it's a standard principle. If you do say, just minus it directly from the cost. And then if they give you a percentage, let's say 20%, then you're simply going to say multiply by 20 divided by 100. But if they say 5 years or 4 years or whatever, it means that you're just going to divide it directly with 4 years or that 5 years. Second one, diminution balance method or the reducing balance method. It is the cost, and then you minus the residual value, and then you minus the accumulated depreciation. The difference between these two is because the cost you just go straight. The only effect on that one is only the residual value, and then you multiply that by the rate. In terms of the diminishing or the reducing, you go cost minus residual minus accumulated depreciation, multiply by the rate, and then you divide that by the number of years if you are given the numbers. Last but not least is the production units method. So you take the units produced during the year and then you divide it by the expected number of units. All of this information is usually given. You just have to give and take. Okay. So that's how easy it is. Acquisition of the property, plant, and equipment. When asset is purchased during the year, let's say 5 or 6 months prior to the year end, those months should be apportioned. So this is how it goes. They give you the cost, and during the year, they decided to buy another asset. So you just have to add the cost together. But when you do the depreciation, you have to do it separately. You're going to deal with the first cost, and then you apportion it according to, sorry, you multiply or you calculate your depreciation accordingly. And then with the second addition, you're going to take the asset during the year, multiply by the rate given, if not the initial one. And then you're going to look at how many months am I left towards the end of the year. And then you portion it. It can be 3 months, it can be 12 months, any months. And then you multiply that, you divide it by 12. That's how it works. Disposal of an asset, that's where you're going to recognize whether you have disposed or sell your asset or sold your asset with a profit or loss. When an asset is no longer useful for an entity, it must be removed from the books and the asset register. So some of you might have realized that your employer might say that we are selling laptops, right? So when they sell them, they realize that it's no longer useful for the firm. That's why they're actually taking it out of the books of the business, or they take it out of the register. So usually they say they sell it at a lower cost. So the reason for that, it might be the issue of they've already purchased the new laptops, or they are planning to purchase the new laptops for staff members. Let's look at the ways in terms of disposing an asset. We scrap it, we sell it outright, or we can do what's called the trade-in. Prorata, in terms of the depreciation, there are steps to be followed. Let's look at the first one. Dealing with the disposal of an asset, you debit the depreciation, and then you debit the contract allocation account, which is the accumulated depreciation. 2, transfer the total accumulated depreciation of the disposed asset to the realization account, and then you debit the accumulated depreciation. Remember, that's an asset contract account, and then you credit your realization account. You transfer the cost price of the disposed asset to the realization account, you debit the realization account, and then you credit your asset account in question. It can be machinery or vehicle or building, whatever the asset it may be. And then you record the amount and on the realization, so for cash. We are receiving the money, that's why you see bank being debited, and then you credit the realization account. Plus, the asset itself is gone, it's no longer there. Credit, I think it will take you back to the previous training unit of the trade and other receivables. So you debit your trade receivables as an asset, and then you credit your realization account. Let's determine the profit or loss on the disposed asset. If the total amount of the debit side on the realization account is bigger, actually I was supposed to say not in, but in, sorry, not in, but is, rather, the credit side. It means that the asset was disposed at the loss. That's how you determine it. And then if the total amount of the credit side of the realization is bigger than the debit side, asset was disposed at a profit. That's the whole idea of having a disposal asset. So it's called the realization account. But we'll see that. Transfer of the profit or loss to the on the disposal of that type of an asset. So let's see at a profit, you debit the realization account, you create the profit on the disposal account. With a loss, you debit the loss on the disposal account and credit the realization account. But the last part is part 2 of the PPE. It's intangible. This type of asset, you can't see it or you can't touch it. We're looking at the financial assets or the investments. All you know is you've invested a certain amount of money with the financial institution. You can't see it, you can't touch it. All they can do is to send you the statement to see where you are with it. What is it? It is identified as a non-monetary asset without physical substance held for the use in the production or supply of goods and services, rental to others, or for administration purposes, which are controlled by an entity as a result of the positive events for the future economic benefits that are expected to flow to the entity. Types of the other financial assets in the message of recording them. When the financial asset is acquired, the relevant financial asset is debited and the bank account is actually credited. Right. The cash investment, an entity will try to obtain the highest yield and the interest on the investments. Right. So this part of the PP, it's normally examined. I'm not sure, but sorry about that. I know it's bigger when you do your postgrad in accountancy. You will find a lot of that, right? Particularly on the journals. Now we get to the question. So this is our final installment in this class tonight. Right. Question relating to property, plant, and equipment. The following information extracted from the accounting records of PT Limited. All right. If you go to your tutorial letter 102, I know I'm linked under the My Research, but I struggled to find that one. I hate to use my old one. But if you can, this question is actually question 1 in your tutorial letter 102. If you do have time, please make sure that you do it. Right. Right. Number 1, balances at the 1st of January 2022. It's actually the beginning of the year. Just a moment. All right, I'm back. I've got vehicle at cost of 280,000 rand. That's a mistake. It's supposed to be 28,000. And then we've got equipment of 2,800 rand. Accumulated depreciation for both vehicles and equipment, 14,268. And then equipment is 543. Information which relates to the non-current assets took place during the year. On the 1st of July, Pooty Limited sold a delivery vehicle to Mr. Spencer for 7,200 rand cash, and the process from the sales transaction were used to help finance the purchase of another vehicle on the same date from Dealer Motors Limited for 22,000 rand cash. Cost price of the vehicle sold was 12,000 rand, and its accumulated depreciation amounted to 6,455 on the 1st of January 2022, right at the beginning of the year. At the end of the year, Pooty Limited sold a printer to Mr. Moon for 720 rands cash. Cost price of the printer is 900 rand, and the accumulated depreciation on this printer amounted to 164 at the beginning. Depreciation at vehicle is 20% per annum on the diminishing balance method. Remember, that's a reducing. And equipment at 10% per annum on the diminishing balance method as well. The financial year commences on the 1st of January 2022. Let's look at the required. Do the ledger account of Pooty Limited property, plant, and equipment for the year ended. Okay. Do you guys have an idea on what is actually happening here? Okay, let me just do this question for you. All right, the first thing that you must do is you need to calculate the depreciation. Right, the first depreciation that you're going to do is let's look at the vehicle. So in terms of the vehicle, remember the original cost is 28,000 rand, and then one of the vehicle that was 12,000 rand out of the 28,000 rand has been sold. This is what you're going to do because we are now complying with the reducing balance method. You're going to say cost 12,000 rands, and then you minus its own accumulated depreciation at 6,455, and then you're going to get the carrying value, which is equals 5,545, right? And then remember, we are actually following the reducing balance method. So you're just going to say multiply by, what's the rate there? 20%. And then remember, it was actually sold in the middle of the year. Then you just say 6 divided by 12. And everybody, are you guys clear on this part? It's a reduced diminishing balance method. Remember, is the cost minus the accumulated depreciation and minus the residual value. But we don't have the residual value. So we just have to go straight by saying that cost minus the accumulated depreciation, and then you multiply by the percentage given, and then you go into a portion by looking at when was it sold. All right. So we had it for 6 months period, and then we're going to say 6 multiply, my apologies, 6 divided by 12. So the final figure is 554, 2,250. Are you all clear? That's your depreciation for the sold vehicle. Okay.
Yeah.
Depreciation for the sold vehicle. Are we fine with this part? Can I move on? Can I move on? Can I move on, guys?
Yeah.
Okay. So you're now going to calculate the depreciation for the existing. Vehicle. Remember, not all of the vehicle has been sold, right? So what you're going to do is you will say 28. Remember, part of the vehicle has been left, and then you minus the cost of the sold vehicle. I think it's 12,000 rand, right? And then you get what's called the net cost or the actual cost for the existing vehicle. So how much is 28 minus 12,000? I think it's 16,000 rand. Okay, meaning that the cost of the vehicle that you are left with is 16,000 rand, and you're going to have, remember, we're complying with the diminishing balance method. So you'll take the accumulated depreciation, since we don't have, we call it, the residual value, right? So the accumulated depreciation for the existing is 14,268, and then you're going to minus 6,455 for the sold one, and your net accumulated depreciation 7,813.00. Okay, and then what you're going to do, you put it in the brackets because it's still your accumulated depreciation, just to get what's called the carrying value. Okay. And then you're going to say 16,000 minus 8187. Sorry, man, 7813. It's 8187. 8187, and then you multiply this by 10, right? And then you divide it by 100. Can we apportion it? No, because it's for full 12 months. So your depreciation here would be equals 1637.40. That's the depreciation amount. Okay. Remember, we bought another car during the year, right? When we disposed that one, we bought another one. You remember? So the cost was how much? 22,000 rand. Was there any accumulated depreciation? No. Then you say minus 0. Sorry about that. Say minus 0. When you multiply this by 20%, then you multiply it by 6 months divided by 12. We had it 6 months before. We can close off. Then your accumulated, your depreciation will be 2,200 rand. Very happy? All right, total depreciation for the car. The first one was 554.50. We're going to add the second one, 1637.40, and then you're going to add the third one, 2200 is 2,200 rands. Right. So how much is the total depreciation? Can somebody help me with the figure there quickly?
It's 4,391.40.
Oh, sorry, give it again, please. It's 4?
3.
4391. 91.
40.
40. That's your total depreciation, right? For the vehicle. Okay. Can you guys allow me to move on to the next one? I'm going to calculate the depreciation for the equipment. Right. Right. The depreciation for the equipment, you're going to look at the existing one. And you are going to say how much is the existing one. I help you with the first one, guys. Okay, let's do this. All right, the initial cost is 2,800 and then minus the accumulated depreciation. The reason for that is because we are complying with the diminishing balance method, right? And so your net cost, sorry, the cost 2.8 minus 900 should be 2.8 minus 900, 1.9. Okay, and then let's look at each accumulated depreciation. So you are going to have accumulated depreciation is 543 minus the one for the sword. How much is it? 379, right? Okay, and then we're looking at carrying value. Is how much?
1,900.
Okay. How much is the carrying amount? How much is the carrying amount? I've got 1529.00. So you multiply this by how much is the rate there? Ten divided by 100. Then you're getting how much? 152.10, right? All right, let's have a look at the sold one. So you're going to take the cost and accumulated depreciation. Cost, you must just look up there, it's 900. And then the accumulated depreciation is how much? 164, right? And carrying amount is how much? So the carrying amount is 736. You multiply this by 10 divided by 12. Is that correct? Sorry, 10 divided by 100, not 12. So how much does it give you? 73.60. Right. Then you're going to have what's called the total depreciation. So it's going to be 152.10 plus 73.60. Please give me the total figure there. Okay, you guys get it? Let's see. I've got 225.70. Is that all what you got, guys?
Yes.
You got that? Okay. The reason why I started that is because I wanted to show you what's called the realization account. That's the whole idea of doing this. So let's start with the realization account, and then I'll come to, should we have time, and I'll come to, what do you call it? The other realization account. Right, guys, with the realization account, every time when an asset has been disposed, just know that it's going to be a realization account. The reason for that, we just want to determine if the asset has been disposed with a profit or it has been disposed at a loss. Okay. So we're just basically going to detail for. Okay. So you start by saying you're debiting the three things that goes through your realization account. You debit the cost of sold asset. Somebody help me quickly. How much is it? 1,000. Do we agree? Remember that? Do you all remember that? Do you all remember that? Okay, no, that's fine. I think when you've got time, you can just, right. If the time, please make sure you visit this question. Accumulated depreciation, the sold asset. How much was it? Accumulated depreciation. How much was it? Remember that? 700,50. You all remember that?
Yeah.
You all remember that? So basically what you're going to do is you're going to take the total of the depreciation for the sold vehicle along with a depreciation, so the accumulated depreciation for the sold vehicle. Okay. So it's actually 6455, it's given there, plus the depreciation of that sold vehicle, which is 554.50. It totals to an amount of 700,950. Everybody happy? So, but how much was this vehicle sold for? Because it has to be included as well. Okay. How much was the cost of the vehicle sold? How much did we sold it for? 7,200 rand, right? Then you just credit vehicle. So, how much is the amount? 7,200 rand. Yes. Okay, so this is what we're going to do. We're going to compare the credit with the debit. How much is the total credit? How much is the total credit? This gives us a total of how much? Oh, sorry. Okay, total credit. I'm just going to write it down here. Total credit. It's 14,209.50. Here. Remember this, guys. I'm just showing this, but it's a T account. Right? Please make it in the form of a T account. It's 14,209. 1,000 rand. Okay. But this is where we are determining, because our credit is greater than our debit. That means that we've got a profit on sale of an asset. How much is the difference? 2209,50.
Yeah.
29,50. I think I made a mistake. 2209,50. Are we all clear on this one?
Yeah. Well.
All right. Profit on the disposal of an asset, it goes the income statement. All right. Let's have a realization of, okay, that's for the vehicle. And then now let's look at your debit. Now doing the equipment, right? Your debit. Cost of the equipment sold. But it will always be like this, right? Don't ever confuse yourself and put the other things. Accumulated depreciation. Remember, the accumulated depreciation is for the sold asset. accumulated in a mistake, and the depreciation of that sold asset. Okay. Credit the equipment sold. But Jimmy, how much was the cost of the equipment sold? You would agree with me on this one, 900. Then how much was the accumulated depreciation? Amanda? That's what we are crediting on, right? 237,00. Okay, and the equipment sold, how much is it? 720. 720,00. So this one is 237,60. What's the difference there? What's the difference? So we've got, I think our credit is also greater than our debit as well. So it means that we've got a profit on the disposal of an asset. Please calculate quickly, then give me the figure.
57.
7 rands, right?
57,60.
57,60, right?
Yeah.
All right. All right, this is how you calculate your profit on the disposal of an asset, all right? And there are 3 things that you need. You debit the cost of an asset sold, and then you credit the accumulated depreciation. Remember, the accumulated depreciation consists of the accumulated depreciation of that sold asset, including the current year depreciation for that sold asset. And then you're going to look at how much was the vehicle sold for, right? And then you're going to credit that, and then you're going to compare the two. If the credit is bigger than your debit, then you've got a profit on the disposal of an asset. And then if the debit is greater than the credit, that means you've disposed your asset at a loss. Makes sense?